Ladies and gentlemen, before we even step into today's conversation, I want you to ask yourself one simple question. The ounces of silver are you holding today? Because the truth is, while everyone was distracted watching markets go up and down, the real crisis has been unfolding quietly right under our nose. And the only people who will be prepared when the house of cards finally collapses are those who understood the value of real, tangible wealth. People keep asking me what they should be doing right now. And every time I hear that question, I realize how late most people still are, because the real question isn't what stock to buy or which crypto is going to double next month. The real question is much more uncomfortable, much more revealing. How much real money do you actually own? Not digits on a screen, not promises from a bank, not an ETF prospectus, but real physical silver that you can hold in your hand. For decades, we've been living in a world where people were trained to trust paper, trust the dollar, trust the government, trust the central bank, trust the idea that value can be printed, borrowed, or digitally created without consequences. And for a long time, that illusion worked. Not because it was sound, but because it was delayed. Inflation didn't show up immediately. The cracks didn't appear all at once. But now, those delays are gone. The consequences are no longer theoretical. They're visible in every grocery bill, every rent increase, every shrinking paycheck. And yet, most people still don't understand what's happening. They think inflation is temporary. They think the authorities have it under control. They think interest rates, press conferences, and political talking points will somehow reverse decades of reckless monetary policy. But once you understand how the system works, you realize something crucial. There is no exit without pain, and there is no solution that doesn't further devalue the currency. That's why physical silver matters urgently. Silver isn't just another investment. It's a form of money that exists outside the system that created this mess. It doesn't depend on confidence in a central bank. It doesn't rely on a government's ability to repay debt. It can never realistically pay back. Silver doesn't need a bailout, a guarantee, or a narrative. Its value doesn't come from belief. It comes from reality. When people tell me they own silver, the next question is always the same. Do you actually have it? Because owning silver on paper is not the same thing as owning silver in reality. A claim is only as good as the system backing it, and that system is drowning in debt when stress enters the financial system, and it always does. Paper claims are the first things to fail. Physical ownership is the difference between being a creditor and being an owner. Silver is uniquely positioned in this environment. It's undervalued relative to gold, historically cheap in real terms and increasingly scarce at a time when demand is rising. Unlike fiat money, silver can't be printed. Unlike many financial assets, it has no counterparty risk. And unlike most investments people chase today, it has thousands of years of monetary history behind it. That history isn't nostalgia, it's proof. Proof that silver has survived every currency experiment, every empire, every debt crisis. The urgency comes from timing. Once the public fully realizes what's happening to their purchasing power, it won't be gradual, it will be sudden. Confidence doesn't erode slowly, it collapses. And when that happens, people don't calmly rebalance portfolios, they rush for safety. By the time silver is on the evening news, by the time everyone agrees it's a good idea, the opportunity won't look anything like it does today. Right now, silver is still treated as an afterthought. It's ignored, dismissed, and misunderstood. That's exactly how real opportunities look before they become obvious. The same people who mock it today will be the ones chasing it later at much higher prices. The difference is preparation. Those who understand what's coming don't wait for permission. They act before the crowd, not after it. Physical silver is not about getting rich quick. It's about not getting poor slowly. It's about preserving purchasing power in a world where currencies are designed to lose it. It's about stepping outside a financial system that rewards debt, punishes savers, and pretends that money printing is wealth creation. So when I talk about urgency, I'm not talking about hype. I'm talking about math. I'm talking about history. I'm talking about a system that cannot be fixed without destroying the value of its own currency. In that environment, holding physical silver isn't extreme, it's rational. The extreme position is trusting that this time will somehow be different. The real risk isn't owning silver. The real risk is realizing too late why you should have. For a long time, silver has been one of the most misunderstood and mispriced assets in the global market. People look at the price chart, they see volatility, they see periods of stagnation, and they assume nothing is happening. But that's only because they're focused on the surface instead of the forces underneath. Price doesn't move in a vacuum. It responds to pressure. And the pressure building beneath silver today is far greater than most investors realize. What we're seeing now is not a speculative spike or a temporary trade driven by headlines. This is a result of years of distorted monetary policy finally colliding with physical reality. When central banks hold interest rates below the true rate of inflation, they are telling you something very clearly. Cash is trash. Every dollar, euro, or yen saved is losing purchasing power by design. In that environment, assets with no yield but real scarcity suddenly become far more attractive, and silver is at the top of that list. Silver's bullish dynamics start with simple math. Supply is constrained and demand is expanding. Unlike fiat currency, silver cannot be created with a keystroke. Mining output is relatively flat. Extraction costs are rising and new discoveries are rare. At the same time, silver is being consumed, not just stored. Industrial demand continues to grow, especially in energy, electronics, and technology sectors that governments themselves are heavily subsidizing. Every ounce used in production is an ounce that doesn't come back to the market. Now, layer monetary demand on top of that. As confidence in currencies erodes, investors don't run to bonds yielding less than inflation. They don't protect themselves with paper promises. They move toward tangible assets with intrinsic value. Gold usually gets the spotlight first, but silver has a history of outperforming gold once monetary fear takes hold. It's cheaper per ounce, more accessible to the public, and far more volatile on the upside when investment demand increases. Another critical factor is relative valuation. Historically, the ratio between gold and silver has been far lower than where it stands today. That gap doesn't stay wide forever. Either gold collapses, which makes no sense in an inflationary environment, or silver rises to close the gap. History suggests the latter, and when that adjustment happens, it's rarely slow or polite. Silver doesn't grind higher, it moves in bursts, often catching investors off guard. What keeps silver suppressed for long periods is not a lack of value, but a lack of urgency. As long as people believe inflation is under control and the financial system is stable, they delay action. But markets don't wait for consensus. The moment that perception shifts, the same leverage that held silver back works in the opposite direction. Small changes in demand create large price movements because the physical market is much tighter than the paper market suggests. And that's another point most investors overlook. The paper silver market is enormous compared to the actual amount of physical silver available. Futures contracts, derivatives, and synthetic exposure have created the illusion of abundance. But when investors start demanding delivery instead of settlement, that illusion disappears quickly. Prices don't rise because analysts say they should. They rise because real metal is harder to obtain at current prices. Inflation expectations play a huge role here. Even if official numbers are manipulated or revised, people feel inflation in their daily lives. When confidence in purchasing power breaks, it doesn't come back easily. Silver benefits not just from inflation itself, but from the loss of trust in institutions tasked with controlling it. Once that trust is gone, monetary metals were pricked to reflect reality rather than policy statements. Another bullish force is psychology. Silver has spent years frustrating investors, which means positioning is still relatively light. This is not a crowded trade. There is no euphoria, no widespread public participation. That's exactly how bull markets begin, not how they end. The biggest gains don't happen when everyone agrees. They happen when most people are still skeptical. The mistake many investors make is waiting for confirmation, They want proof in the form of much higher prices before they're willing to act. But by then, the easy part of the move is already over. Bullish price dynamics reward anticipation, not reaction. Silver doesn't wait for comfort. It punishes hesitation. What lies ahead isn't about prediction, it's about probability. Massive debt, persistent inflation, currency debasement, and tightening physical supply all point in the same direction. Silver doesn't need a perfect storm, it's already in one. The only thing missing is widespread recognition. And when that arrives, prices won't politely ask permission to move higher. Silver has always been a metal of delayed response and sudden repricing. The dynamics are in place, the pressure is building, and when it releases, the move will remind people why silver has never been cheap, only temporarily misunderstood. If you want to understand what's really happening in the economy, you have to stop listening to what policymakers say and start watching what they do. Words are cheap. Press conferences are designed to calm you. But actions tell the truth. And the actions taken over the last several years reveal a system that is structurally broken and increasingly desperate to keep itself alive. The macroeconomic forces at work right now are not random and they're not temporary. They are the inevitable result of decades of bad decisions finally reaching their limits. At the center of it all is debt. Not just government debt, but total systemic debt, public, private, corporate, and consumer. The global economy is built on borrowing that can never realistically be repaid. The only way this system functions is by rolling old debt into new debt at lower and lower real interest rates. That's not growth, that's survival. And when interest rates rise even slightly, the entire structure starts to wobble. Central banks understand this, which is why they are trapped. They talk tough about fighting inflation, but they can't actually do what's required. Real rates would need to be significantly positive to restore purchasing power and reward saving. But if that happened, asset bubbles would burst. Governments would face exploding interest costs, and heavily indebted economies would slip into deep recession or worse. So instead, policymakers choose the lesser evil, inflation. They sacrifice currency value to keep the debt machine running. That choice has consequences. Inflation isn't just higher prices, it's a transfer of wealth. It rewards borrowers and punishes savers. It erodes wages, distorts investment decisions, and creates social and political tension. And once inflation becomes embedded in expectations, it's incredibly difficult to contain. You can't print your way out of a problem caused by too much printing. Yet, that's exactly the path being taken. Another major force is the loss of confidence in institutions. For years, people trusted that central banks knew what they were doing. That faith is fading. Official inflation numbers no longer match lived experience. Economic growth feels hollow. Job numbers look strong on paper, yet living standards continue to fall. When reality and statistics diverge for long enough, people stop believing the statistics. Currency debasement is not an abstract concept anymore, it's visible. When every major economy is running deficits, monetizing debt, and racing to the bottom in purchasing power, currencies lose their anchor. In a world where everything is being printed, scarcity becomes invaluable. Real assets start to matter again, not because of speculation, but because they exist outside the political system. Globalization is also shifting in ways that add pressure. Supply chains are being restructured, production costs are rising, and efficiency is being sacrificed for perceived security. That means higher costs across the board. The era of cheap goods masking monetary inflation is ending as production becomes more expensive and less efficient. Inflation becomes harder to hide and harder to reverse. Meanwhile, financial markets are addicted to liquidity. Every time there's stress, the response is more stimulus, more intervention, more money creation. This has trained investors to expect rescue, which encourages even more risk-taking. It's a feedback loop that inflates asset prices far beyond fundamentals while doing nothing to strengthen the real economy. When those bubbles deflate, the response will be the same. Even more aggressive monetary easing. Another overlooked force is demographics, aging populations and funded liabilities, and shrinking workforces place enormous strain on government finances. Promises made decades ago are coming due, and there is no honest way to pay for them. Taxes can't cover the gap, growth can't fill it, and default is politically unacceptable. That leaves only one option to valuation. All these forces point in the same direction: slower real growth, higher inflation, weaker currencies, and greater volatility. This is not a normal business cycle that can be smoothed with policy tweaks. It's a reckoning with mathematical reality. You cannot build prosperity on debt forever, and you cannot destroy the value of money without consequences. The biggest mistake people make is assuming stability is the default. It isn't. Stability has been artificially maintained through intervention, and the cost of that intervention keeps rising. At some point, confidence breaks, not gradually, but suddenly. When that happens, markets don't behave rationally. They reprick violently. Understanding these macroeconomic forces isn't about predicting the exact timing of the next crisis. It's about recognizing the direction of travel. The system is moving toward more inflation, more intervention, and less trust in paper promises. Ignoring that reality doesn't make it go away. It just leaves you unprepared when the consequences finally arrive. Most investors believe they're prepared because they've done what they were told. They diversified, they followed conventional advice, they trusted the professionals, and they assumed the system would continue functioning more or less the way it always has. That belief is comforting and dangerous because preparation isn't about following the crowd. It's about understanding risk before it becomes obvious. And right now, the average investor is far more exposed than they realize. The biggest misconception is that risk is something that shows up suddenly like a market crash or a recession headline. In reality, the most destructive risks build slowly, quietly, and invisibly. Currency debasement, negative real interest rates, and runaway debt don't trigger panic overnight. They lull people into complacency while steadily eroding purchasing power. By the time the damage is acknowledged, it's already done. Most portfolios today are built for a world that no longer exists. They assume stable currencies, functional bond markets, and central banks that can control inflation without consequences. Bonds, once considered safe, now guarantee losses in real terms. Cash, traditionally a defensive asset, is being destroyed by inflation. Yet investors hold these assets in large quantities because they feel familiar, not because they make sense. Another problem is overconfidence in financial products. ETFs, mutual funds, derivatives, and digital instruments give the illusion of ownership without the reality of control. Investors believe they own assets, but in many cases they own claims dependent on liquidity, counterparties, and system stability. When markets function smoothly, that distinction doesn't matter. When they don't, it matters a lot. The average investor is also heavily dependent on the advice of institutions with conflicts of interest. Wall Street profits from activity, not prudence. Governments benefit from inflation, not saving. Central banks prioritize system stability, not individual purchasing power. Yet investors assume these entities have their best interests at heart. History suggests otherwise. What's missing from most portfolios is protection against systemic risk. Not volatility, but failure. Not a bad quarter, but a bad system. People insure their homes against fire, their cars against accidents, yet leave their life savings completely exposed to monetary policy. That's not rational behavior. It's conditioned behavior. There's also a dangerous reliance on recent history. Because markets have been supported and bailed out for so long, investors assume that will always be the case. They expect intervention to save asset prices without considering the cost of that intervention. But every rescue weakens the currency further. You can prop up markets or you can protect money. You can't do both indefinitely. Another sign of underpreparedness is the belief that warning signs will be obvious. They won't. Crises don't announce themselves politely. They emerge through small changes, longer delays, tighter liquidity, unexpected restrictions, sudden policy shifts. By the time headlines confirm the problem, positioning has already changed and options are limited. Most investors also underestimate how quickly sentiment can flip. Confidence is not a linear function, it's binary. People believe in a system until they don't. And when belief breaks, behavior changes fast. Assets that were ignored become desperately sought after. Assets that were trusted become toxic. Being prepared means being early, not being right at the same time as everyone else. The uncomfortable truth is that preparation often looks wrong before it looks smart. Holding assets that don't produce income, questioning official narratives, and prioritizing preservation over growth all feel unnecessary in good times. But good times are exactly when preparation should happen. Waiting until fear sets in is not a strategy, it's a reaction. The average investor is underprepared, not because they're careless, but because they've been taught the wrong lessons. They were taught that risk is volatility, that inflation is manageable, and that money itself is stable. Those assumptions are being tested now. And when assumptions fail, so do portfolios built on them. Preparation isn't about predicting collapse. It's about respecting reality. It's about acknowledging that systems built on debt and debasement eventually demand a price. Those who understand that don't wait for reassurance. They act quietly, deliberately, and ahead of the crowd, not out of fear, but out of clarity. So tonight, right now, I want you to think about your position. I want you to think about your wealth and how protected it really is. Because when fiat currencies are debased, when central banks signal more money printing, and when